Thank you for coming. My name is Jasmin Suministrado and I'm your moderator for this event. Before we proceed, let me first talk about two things. One, the webinar system we are using, and second, the profile of the participants in the room. So for the webinar system, you all have a control panel that looks like this. I think the slide's just taking a bit of a time to load now. Voila. Okay, and you have an icon, a button that you can use to hide and unhide this control panel. And you also have a chat box that you can use to relay questions and comments to us. Please identify, indicate your organization, and please make sure to click Send Question to Staff so we get them. And we'll try to consolidate all the questions and comments, and we'll try to address as many of them during the question and answer portion of the webinar. Also, we're going to launch several polls during the webinar, and it would be good if you can participate by clicking on the answers on your screen. Now, about the profile of the webinar of the people in this webinar, we have almost 400 people registered, and the profile is quite diverse. By region, 30% are from Asia, 24% from Africa, and 17% from Latin America. By type of organization, majority, about 40%, are from the insurance industry, followed by those from NGOs at 21.5%. And by participation in microinsurance, we see that we have almost the same proportion of risk carriers, distribution channels, and enablers, all at about 20%. So looking at these three graphs, we expect to have a rich mix of questions, comments, and ideas during the question and answer portion. So at this point, let me introduce you to the voices also from different parts of the world that you will be hearing in this webinar. We have Brandon Mathews, Head of Emerging Consumer for Zurich Financial Services, facilitator of the Microinsurance Network's Distribution Working Group and member of the network's Executive Committee, as well as the Facilities Steering Committee. Then we have Anja Smith, Director at the Center for Financial Regulation and Inclusion, or Cenfri, and author of the Facility Commission paper entitled Beyond Sales, New Frontiers in Microinsurance Distribution. We also have Pranav Prashad, Microinsurance Officer at the facility and focal point for the use of new technologies in microinsurance, with quite an experience in providing insurance services to low-income households in India. And finally, we have a guest speaker, Peter Gross, the General Manager of Microensure in Ghana, who will be sharing with us the Microensure experience in distribution. So now I turn you first over to Brandon Mathews, who will introduce us to our webinar topic. Brandon?
Thank you. And good morning, good afternoon, good evening to everyone. It's a pleasure to speak with you today. We're going to talk about microinsurance distribution. And distribution is definitely a decisive element of the client-insurer relationship. You'll see here on the screen that I'm going to present my comments by looking at the customer, the top half of the screen in green, and the insurer, or the business, down below. But I'd first like to start with a quick poll to know a little bit more about you and to ask you, what is your primary interest in attending this webinar and thus for your interest in microinsurance? Are you interested in customer value, so helping low-income households to become resilient to risk? Business value, the growth opportunity to the industry and to its partners, or both equally? The poll will be open for another, say, 5 seconds. Okay, and we'll close the poll now and should just get the results. So we have 16% for customer value, 4% for business value. If I could have voted, I might have put that in, but certainly we all agree, or there's a great majority saying that it's both equally. And that's exactly right. In fact, for all audiences, I think we can say that distribution is important to both sides, and so I firmly believe that you're in the right place. Distribution defines how the product is going to work for both the customer here and the insurer. And the distribution moment not only will establish that relationship for the immediate term, but also make very important, establish very important variables for the claims moment when it's important to deliver to the customer. So at the time of distribution, the customer needs to be confident that the risk is transferred. A customer that is confident and knows that their risk is transferred to the insurer, knows that the product is working, and then is able to take new opportunities with her money or his or her money. And this is really crucial in the low-risk, low-reward financial life of low-income families, the ability to take on other opportunities, knowing that their risks have been insured. Also, when distribution is effective, the insurer will know who or what is insured and for how long. This permits better customer care, preparation for the critical claims events, and also making sure that their risks are balanced. At the moment of claim, having established this relationship in the right way in the distribution moment, one can have realistic expectations on both the customer side and the distribution side, and on the insurer side. This reduces the loss adjustment expenses and the hassle to the customers. Both sides have a good idea of what is in the policy. So what is a good sale? Well, certainly starts with some clear, plain language. Transparency on the coverages, both in writing and in the sales pitch, make it easier for both customer and insurer to establish this good relationship. An attractive offering. This needs to appeal to the customer, to the needs and wants of the customer, but also needs to describe something that the insurer can cover over the longer term. And last, but certainly not least, is a straightforward transaction. Fitting the insurance transaction into the customer's day so it feels and looks like something the customer is familiar with, as well as into that of the distribution partner, is a very important key thing to do. So today we're going to see a handful of examples where innovations are reducing cost and increasing effectiveness to expand access and outreach. These are these three elements. Reducing cost. While I work at a big insurer, you might think that this is about permitting greater profitability, but it can also allow the price to be brought down to where greater access is provided to the market. Increased effectiveness is about better understanding of the product features and benefits, both on the customer side and on the insurer side, and as well with the partner, allowing this group to fix the problem first, the first time. Expanded access and outreach are core goals of microinsurance, and these are mutually reinforcing with these other ones because the expanded access and outreach creates scale. So while we talk today about distribution, there are many other items, many other topics in microinsurance, of course. As we see here, distribution, in fact, isn't even just the sale itself. It's also including the premium collection, customer care, how to handle endorsements, and how the distribution channel insurer will make sure that the customer can use the product effectively. These adjacent topics, from financial education through to actuarial, are handled by various working groups in the Microinsurance Network, either working groups or task forces. But today we do focus on distribution. So let me give a quick advertisement for both the Microinsurance Innovation Facility and the Microinsurance Network. If you have a great idea for microinsurance, please contact the facility. The facility has three major elements of its work: research, it has a fellowship program, and it also has an innovation grant program. It is a terrific clearinghouse for innovations. Now, if you work for a great organization, please call Veronique Faber at the Microinsurance Network. There are about 60 institutions represented here from government, academia, industry, and annual membership for an entire organization is about €500. And to give an idea of what can really help, a $10,000 donation provides seed funding for a working group. And finally, of course, if you have a great desire and experience, absolutely get involved with any of the working groups over at the Microinsurance Network. So now, let me please hand over to Anja Smith of Cenfri, who will present findings from her excellent research on alternative distribution.
Anja?
Thanks, Brandon, for that. Thanks, Jasmin. Thanks, Brandon, for that very, very focused and insightful introduction. I thought it would be appropriate to start my presentation with a quick overview of the definition for alternative distribution that we used in our paper. The first characteristic that most of the alternative distribution models we identified shared is that they are able to achieve scale through concentration. They reached into concentrated client groups and not only engage in individual sales, although some of them also do that. They also tend to have the presence of an infrastructure footprint. This footprint can be physical, so bricks and mortar, or in some cases virtual or electronic, such as GPS-enabled payment devices. Most of the models also all share the characteristic of a transaction platform. They are able to collect premiums through this platform, whether cash or electronic. And when we defined our approach to identifying alternative distribution models, we decided that we would like all of the models to also sell standalone voluntary products where clients have a choice about whether they want the product or not. Lastly, most, but not all of the models share the characteristic of having some type of trusted brand present. And in for many of the successful models, this has really proved essential. I think it is important to highlight what alternative distribution is not in terms of the definition we employed. We decided to exclude all MFI-based distribution because this generally tends to be compulsory, and also exclude all bank assurance because bank assurance has been around for a while now and we don't always consider it alternative. In reviewing our models, we identified a total of 14, but now I'm just going to briefly take you through 5 interesting cases that emerged out of our review. And these 5 cases were selected to provide a representative overview of the different categories of business models and issues that we encountered in our review. Now, the first case is that of the South African insurer Hollard, as well as the cash-based low-income clothing retailer PEP. And I think it's important to note up front that PEP has always been committed to ensuring value to clients and is known for this. Their particular product or product range includes various individual and family funeral options, and these products are literally sold on the shelves in the store in cell phone starter pack type packaging. Now, it's always difficult to get hard data on product sales from insurance companies, but the one thing that we do know is that in 2009, which was a few years into the model, it had sold 215,000 policies, and it continues selling these policies throughout. The premium collection in this particular model and also the initial client information collection is done by PEP, but full client registration, the ongoing service and claims management is provided by a third-party administrator that also participates in the model. The one very interesting thing about this model is that the retailer PEP as well as Hollard had to make certain product changes, in particular pricing changes, quite early on in the model when they discovered that they had significantly underestimated risk in the market. And rather than allowing the products or the prices of the products to simply be increased, the partner, in this case PEP, actually pushed back and said, we can't increase prices, we would rather have to withdraw the whole product range and make certain changes and relaunch it because we want to be known for providing value to our clients. The second case is that of Hollard Take It Eezi, also in South Africa. Now, Take It Eezi is what we refer to as a third-party bill payment provider. It operates through a network of informal vendors, as you can see here on the picture, throughout South Africa. And the one thing that ties it together, or two things that tie it together, are firstly the Take It Eezi brand, and secondly GPS-enabled handheld devices that allow the sales of airtime, electricity, and in this instance also insurance. Like the previous model, it sells individual and family funeral insurance cover. But unlike the previous model, it has really not achieved significant take-up, with only 1,800 in-force policies in 2009. And we think part of the reason this has happened is really the lack of a trusted brand. Take It Eezi is a relatively new brand in the market. It's not well marketed apart from the placement on the stores. So we think people were more reluctant to buy their policies from this particular brand than in the case of PEP. I'm actually going to skip over the servicing and claims that you can see on the slide and move on to the next case. Our third case is that of the Spanish insurance company Mapfre, also operating in Colombia and in this case, and Cudenza, the largest electricity company in Colombia. Now, Cudenza realized that it had a significant amount of client information as well as an extensive bill payment system that could be used in the insurance sales process in some way, and it therefore decided to partner with Mapfre in providing various insurance products to its clients, including life, personal accident, funeral, home, and vehicle insurance. And it sells these products through various ways and approaches, including mail shots, so leaflets that are included with people's bills, the electricity bills when they receive it, an outbound call center, face-to-face sales agents that they will send out to specific geographical areas. It has had significant take-up, with at least 300,000 policies sold in 2008. And in this instance, the product administration in servicing is shared in almost equal ways. Cudenza's call center handles claims, while Mapfre manages the operational side of claims. And I would just like to mention that what has been really interesting about this particular model is the innovative use of client information, where Cudenza has really decided to dig into the information, including payment information, income information, geographical information of clients, to develop its products and sales strategies. Our fourth case is that of Colseguros and the French international supermarket chain Carrefour in Colombia. So maybe I should just note up front what the really interesting characteristic of this particular product that I would like to focus on is. Now, it's a rounding off product where clients are able to buy personal accident insurance with the premium and level of cover aligned to the small change, or the small change they received after completing a purchase at the cashier. So when they receive their change, or before they're about to receive their change, the cashier will ask them whether they are interested in purchasing personal accident insurance. But apart from the personal accident insurance, there are also other more complex insurance products sold in store at a desk where there's an agent present. And there are also certain on-the-shelf products in the store. Now, the personal accident insurance product had sold 2.9 million policies of this particular product had been sold in 2009. The premium collection and client registration process is handled by Carrefour, with servicing and claims in this case being handled by Col Seguros. And we thought this product was really innovative and interesting because it was developed to fit clients' pockets, and work with their available funds in offering them cover. Our last case is that of the credit-based appliance and furniture retailer Casas Bahia, as well as, once again, the Spanish insurance multinational Microinsurance operating in Brazil. And they offer a quite interesting product. It's a combination of a life insurance product, unemployment insurance, as well as some personal accident cover where there are some what we refer to as in-life benefits thrown in with it. And this includes a lottery ticket and certain pharmaceutical discounts. And in terms of the information we've been able to collect, people really value these pharmaceutical discounts, and they will use it a number of times within any specific month to get discounts on certain products as basic as vitamin C, but also other more complex prescription pharmaceutical products. Now, the product is sold in store by the Casas Bahia agents or staff, and all that the insurance company or the business model in this case was able to reveal to us is that take-up has been significant. The policy servicing and administration is shared by Casas Bahia and Microinsurance in different ways. And maybe once again I would just like to pause at the really interesting insight that emerged from this business model for us, and that is that there is basically one point of client interaction only. So clients are able to pay their premiums in the Casas Bahia store, initiate the policy, as well as receive certain after-sales and claims management support from the Casas Bahia agents in the store. Now, in terms of wrapping up, I would like to return to some of the themes or issues that were well illustrated by the 5 cases I've just taken you through. The first is the innovative use of client information. In the case of the Microinsurance Cadenza product, the distribution partner's extensive client information database was used to inform and efficiently target sales strategies to clients whose needs most closely match the benefits offered by the insurance product. The database information was, for example, used to target certain geographic areas in terms of available client income or payment information so that agents could actually visit these clients in their homes. The other conclusion that is well illustrated is also the need for a layered sales approach. So some of the models out of our total of 14 models, specifically here also Cadenza, use multiple distribution strategies, of which passive distribution or a passive distribution approach such as using a call center, in or outbound call center could be one. However, it also recognizes that clients often have a need for an active sales process. So that is why there were sales agents present or in the business model who actually go out to clients in their home. And there's also a recognition that an active sales process may require multiple client engagements, with sales agents returning to certain homes up to 3 times to close a sale. The other quite big insight or conclusion is that alternative distribution model success requires significant investment by both the insurance company as well as the distribution partner, not only in terms of funds but also in terms of time and patience. In the case of financial investments, these may be significant in some cases, especially if the insurer is interested in buying its way into a popular partner. One example of high financial costs or high financial investment costs is that of Casas Bahia and Mapfre, where they had to invest significant amounts in human capital, training the Mapfre sales agents, as well as putting the relevant and proper information technology platforms into the Casas Bahia store. In terms of time and patience, I think the PEP story illustrates well that you may require significant product changes and even changes in your distribution approach in some cases. Now, I think here you ultimately need patient boards on both the insurer and the partner's side, because profit may not be immediately forthcoming. I've now taken you through some of the conclusions and themes, but I think the biggest one for us from the study was that distribution innovation has not been sufficiently client-centric. It's been mainly focused on selling products and collecting clients' premiums, so promoting the interest of the business model, and not so much on the claims process. And here it comes out in two ways. I think the first is in the models that do offer value, the partner commitment to value was really the decisive factor. And the example we have here is the role that PEP took in the relationship with Hollard, where it tried to position itself as the client champion. It did not want to increase the prices of existing products and therefore rather decided to relaunch the whole range. And this lack of client-centric distribution innovation also then raises the question of whether distributors such as Casas Bahia can ultimately become one-stop shops, where clients' only interaction with the business model takes place in one spot or one geographical location or with one brand. Through the 5 cases I've shared with you today, we have reviewed 4 generic categories of alternative distribution models. We've looked at cash-based retailers, credit-based retailers, utility and telecommunications companies, as well as third-party bill payment providers. Now, the question that I would like to pose to you is which of these categories you think would be best able to serve client needs all in one place, so ultimately become a one-stop shop. So we are now moving to you, the audience, for a poll on this particular question. Okay, I am going to give another 5 seconds or so for you to enter your selection. Okay, I hope you've all entered your selections. I assume that the poll is now closed. And we have some results coming through. It seems that 36% of you said cash-based retailers are best able to fulfill this role, 10% third-party bill payment providers, 40% utility and telecommunications companies, and only 14% said credit-based retailers. The conclusion we actually came to is that credit-based retailers, surprisingly, may be best able to fulfill this role because they often already have an existing financial services culture within the store. The staff are more familiar with financial services, and they also have some existing systems. So you don't always have to bring in a totally new system. In some cases, you can simply change the system a little bit. But this doesn't necessarily mean that they are able to deliver the best value through this. So I'm now going to thank you for your patience in listening to me, and we're going to move on to the next presenter, Pranav.
Thank you, Anja, for showing us that there are channels beyond the traditional agents, MFIs, and banks to connect with the local population for insurance. Let's try and develop this further as we go along. Thank you all for tuning in. Just a quick reminder that we are interested in hearing from you. You can use your chat box for sending comments or ask questions. Please go ahead. We are waiting for your answers, comments, and whatever you want to tell us. We heard Brandon talking about good sale and the magical distribution moment, but we are all painfully aware that there are quite a few hurdles in distributing insurance, especially in the rural and the low-income environment. As we start out, let's do a quick poll to see what in your view impacts us the most. Can we have the hurdle poll now, please? So, ladies and gentlemen, what in your view are the factors that impact microinsurance distribution the most? We request you to choose any two. Is it the lack of means for accurate identification and therefore zeroing down on whom have you insured? Is it the low level of financial education and therefore understanding of insurance and insurance products that is a hindrance? Is it the infrastructure deficiency for collection of cash and reaching out to the customers that creates a barrier? Or is it an inherent lack of trust amongst low-income households in institutions and large players? Hope you've made your selections, since we'll be closing the poll in a few seconds. Let's close now. Let's take a minute to see what our listeners feel about it, and we'll have the results on this shortly.
Pranav?
I can't see the figures.
Okay, so our results are 6% for the first one, 36% for the second, which is low level of financial education, 37%, almost equal, for the third one, which is infrastructure deficiency, and 22% for lack of trust in institutions.
So we see a diverse spread in the reasons why insurance gets hampered. And now that we have the issues and challenges that actually impact distribution, let's see how they can be translated into tangible results through the alternate channels, especially the retail outlets, when insurance is one of the many products that a retailer stocks, and the demand on his time is for multiple needs. As we see in the picture here, the customers come in to buy essential items which are necessary for their households and not necessarily a financial promise. Also, since a lot of these outlets themselves are in the remote areas, it's not only the potential clients that need information, but also the understanding of the distributor, that is the shopkeeper, is also limited. In such circumstances, let's see cases and situations in which insurance sale can be facilitated. What inputs can facilitate this entire transaction? In comparison to these small corner outlets, there are also larger outlets emerging in the rural retail landscape, such as the ones that we see here, where customers come to make their monthly purchase as also inputs for their farms. They end up spending quite a time here, and this time that they are here can actually be utilized for talking about insurance and converting it into a sale. As you can see, there is a diverse purchase set here. You have gas cylinders, you have fertilizers, you have other fuel being taken for storage. So the stage is actually set for offering additional services under one roof. And banks have started utilizing it, as you can see in the background, a banking outlet being there under one roof. And hence the customer is also more inclined to listen since he's spending some time here. So the big challenge is for these gentlemen here, the shop assistants, to learn more about insurance, understand what it's all about, so that the gentleman who's making the purchase goes out with a financial cover for himself. We have examples in India through Haryali Kisan Bazaar, which is a farm input chain, which works closely with ICICI Prudential Life Insurance Company and HDFC Ergo for General Insurance Company for selling their products. Let's see how technological tools can assist the process and have been used by various organizations, which include the ones discussed earlier, in their efforts to reach out to the customers. Can technology actually help in unlocking the potential for microinsurance? Let's look at 5 innovations here: scratch cards, handheld machines, mobile phones, smart cards with biometric use, and modified point-of-sale systems. And if they can actually fulfill the entire insurance gamut from low-ticket premium collection, identification of customers, as well as issuing the policy. Let's see how each one of them have been used. Starting with scratch cards, we have the example of Max Vijay in India, where a life insurance policy highlighting the benefits of regular and actually irregular in the rural households savings required a flexible payments mechanism which had a wide outreach. So scratch cards of various denominations were introduced, which were displayed prominently to the customers, which gave them the flexibility to buy in whatever amounts they wanted to buy at an outlet closest to you. So scratch cards actually afforded a product which was designed for flexible payments, a distribution mechanism which supported that flexible payment. Here's a look at the retail outlets in the rural areas that promoted scratch cards. These are small corner outlets, and since there are many in number, so they afforded a great outreach. The effort was required from an insurer to actually build traffic to these outlets, and therefore you see wall paintings, you see in-shop POPs, point of purchase sales materials being displayed, even use of film icons to inform and therefore pull the customers. These are technologically very similar to prepaid telephone prepaid cards. You actually purchase a starter pack, and a company call center activates the policy for you. The one challenge that was faced was that while these provided the outreach, but still they prove very good for top-ups and enhancing your distribution rather than for first-time sales, where the call center proved a better route because it was challenging on demand of time for the shop owner to explain what the insurance was all about, whereas the call center could dedicatedly take the customer through the entire route of insurance. Also the fact that for renewal scratch cards, the amount involved was less, and therefore the customer could come and be out of the outlet with the scratch card in the shortest possible time. Moving on to the handheld technology platform, what can it actually do? Can it actually take an insurance office to the doorstep of the customer? The handheld machine, as you can see in the picture, actually allows an agent or a retailer to feed in all the data in the small machine, which is connected to the backend, and process the transaction on the spot. The various advantages that can be used through a handheld machine are that because it is handheld, it enhances your reach and accessibility. It can issue a on-the-spot policy receipt and even be used for claims processing, therefore facilitating the entire concept of a one-stop shop. Since it stores various programs on the same device, therefore various programs combined with insurance, money transaction can actually be done. And since everything is done through the system, it can help in reduction of fraud itself, plus manage the data that is available, and therefore reduces the transaction time and can perhaps ensure timely disbursement of money should that be required. Actually, these handheld machines can be used for biometric identification. This is the strip where you can actually put your thumb or impression, and actually, like I mentioned, for cash handling through the retailers themselves. Let's see how in-shop insurance pitching and handheld machines combine to complete the insurance process. And we have an example from Brazil, Bradesco, where an in-shop stall, an in-shop stand, where an insurance assistant is there to help you understand the insurance policy, can actually help in this process. A handheld machine is actually used to generate a receipt so that a customer is sure that the transaction has happened and he has something in hand to show for what he has paid for. But can this receipt be actually used in the unfortunate circumstance that it requires before a formal policy comes to the customer? It sure can. It has a definite certificate number, so therefore it translates into an instant sale and a policy with which a customer leaves and can utilize should the need arise. Moving on to mobile phones that have actually become ever present. It's almost like everyone has one, but what can they deliver actually for an insurance product? All three aspects, frankly, on policy administration in terms of online enrollment, in terms of online authorization, in terms of transfer of payments to service providers, reminders to customers, and engaging with the customers extensively on policy updates, if there is a claim, the status of the claims, and from an internal cost angle, an involvement with the field personnel, where they can be given refresher assignments, product updates, clarifications, which in effect lead to huge reduction in traveling costs and training costs. In countries where it allows for cash transfer, mobile phones have been used extensively for even paying premiums through them, as well as money transfers through them, as has been exemplified with the M-Paisa case in Kenya. And we'll be hearing more about this use of mobile phones in the Ghana example through my colleague from Microensure later. The facility will also be trying to diversify the use of these mobile phones in trying them out for cattle insurance in India, and for training agents going forward. The other technology innovation that has become more popular now is the use of smart cards. What exactly are these smart cards? These are essentially a storage device that can store all kinds of data on demographics, health history, land availability, number of cattle, and it's all stored in the small chip that you see here. And it allows for a unique customer code to be generated with a biometric fingerprint identification. Various services can be activated on the smart card, like your connected bank account details, cash transactions, any other insurance policies that you have, so that effectively you have all your information available in your wallet on a small card. Actually, this ability to store information and process transactions is great from an insurance perspective, especially at the service provider's end in identifying the customer, getting approvals, and processing these transactions, as well as helping in diagnosis if your health history is stored on the card. Also, direct debits can facilitate premium collections and claims payment too. But how does enrollment happen for these smart cards? It's actually very simple. It's actually like having a computer in a suitcase where an agent goes out to the customer with a suitcase, a computer, a camera as you can see, takes your photograph, you give your biometric identification, and the card is issued in your own courtyard in the village, as you can see in all these photographs here. These smart cards have been used extensively in one of the largest schemes in India, which is the Rashtriya Swasthya Bima Yojana, as well as in opening the doors for no-frills savings accounts, which give an access for financial inclusion to the low-income households. Building up on the smart cards are the POS systems that have come to be used either at rural kiosks exclusively or even inside the shops, as we saw in the Haryali Kisan Bazaar example. They can actually be used anywhere and can actually be a hybrid online and offline system with a parking database, by which you mean that even if there is no electricity or no connectivity, you can actually store the client information at a database after you've convinced the client on an insurance process. The good part about these rural kiosks is that customers come and spend some time there, because this is not the only service that these people provide. These kiosks, at least in India, have been set up under a government mandate for providing multiple services and are therefore called common service centers, where a customer comes and spends time for land records, rail reservations, for even photocopying and taking printouts through these printers here. So you have an opportunity for creating awareness, convincing the customer about the insurance process which is happening here and here. And since a lot of these kiosks are operated by the local population and the local youth, they have a higher level of trust than a remote different outlet which the customer doesn't know about. These rural kiosks have become popular through service providers such as 3i Infotech in North India, Comat in South India, and have been used by Max New York Life for the life insurance policies, ICICI Lombard for the general insurance policies, and more insurers are wanting to get into this bandwagon because there will be 100,000 such kiosks available. This entire system here of a simple computer and a printer actually allows entry of customer details, the policy issuance and printout, and the hybrid online-offline model updates this through a data sync whenever connectivity and electricity is possible. So the basic infrastructure headaches of the remote rural parts is taken care of through these POS systems, which actually result in significant savings in terms of turnaround times and costs of transaction, solve the low bandwidth and connectivity problems, and obviously reduce the dependency on online systems for policy generation. A lot of success has been received in personal accident policies, small two-wheeler policies, as well as pump set policies which are relevant for the population, which inhibits around these kiosks and outlets. Well, technology, as we can see, can play a huge role, but customer education remains an imperative and an essential feature for which direct contact and customer engagement is required. Under such circumstances, technology is at best a facilitator and a means to an end. The distribution mechanism will still need to reach out to the customers, and which can be achieved through direct contact and talking to large numbers at one place. WAN campaigns have proven pretty effective in the past, and they also create a lot of excitement around the event that is happening, which eventually helps technology to draw them into the insurance fold and manage their risks in an effective manner with on-the-spot delivery of policy, and facilitate from the distribution perspective a mechanism by which the insurer is informed as quickly as possible through the use of various technological tools that a customer is under risk. Having seen these various mechanisms, let's see a practical example of how it has happened in Ghana, and Peter will show us the amazing work that has happened through the mobile phones. Over to you, Peter.
Peter?
Yes, thanks very much, Pranav. Very interesting stuff, and I have some things that I will underscore as I talk through my presentation. Thanks to the facility, as well as to everyone who has joined us. It's a real pleasure to be a part of this conversation, which we at Microensure agree is absolutely critical to the delivery of appropriate microinsurance products to the low-income market. Microensure this year has launched 2 mobile insurance products in Ghana with the 2 leading mobile operators in the country, MTN and Tigo. Together, the 2 companies control about 80% of the Ghanaian mobile market. The first one, which you see on your screen here, is My Life Insurance, distributed by MTN Ghana. It's distributed over the MTN Mobile Money platform via a dedicated menu on the phone that you can see there, which can be accessed via any MTN phone. My Life is the first mobile insurance product worldwide where enrollment, premium payment, policy management, modification, and claims receipt can be completed completely via the customer's handset. So just like Pranav was talking about, it short-circuits a lot of the processes that we are familiar with. We use a USSD interface built for this product by MFS Africa, which allows direct live interaction for the client with their policy at any time they choose. And at the same time, we're still selling via dedicated agents and MTN service centers, but we do plan to sell via the handset in the future. The monthly premium deducted automatically each month from the mobile money wallet is between 35 US cents and $1.75 per month per life insured, for which the subscriber earns life insurance of between $350 US and $1,500 US. Each policy covers the mobile money subscriber and 1 registered family member, so every policy covers 2 people. The second product we're offering, Tigo Family Care Insurance, is a loyalty reward to subscribers which provides insurance cover based on airtime usage. Subscribers have to enroll in the products with a live agent, so it's not automatic for Tigo subscribers. They do have to enroll, just as they do with the MTN product. But similarly, the product is distributed through Tigo service centers by agents who are dedicated to the products. Those agents provide 4 to 5 minutes of client education and enroll the client in an online system. Sorry about that. The policy also covers the subscriber plus 1 family member. So just as with MTN, both a subscriber and one named family member are covered. In the Tigo products, subscribers earn between $150 and $700 in life insurance cover that's based on their airtime usage. And the cover lasts for 1 month, and so we calculate the airtime usage the following month. Once we do that, subscribers receive an SMS message every month to let them know how much insurance they've earned for the coming month. So subscribers are kept up to date with how much insurance cover they have. A few lessons I'd like to discuss that we've had briefly in our short experience with this. These products are growing by more than 4,500 new lives per day, and that's going to double the number of insured Ghanaians, excluding government-based health insurance, within less than 1 year of our launch. And so the potential to double the output of 40 years of insurance in Ghana and 21 companies is quite interesting to us. Obviously, these products are targeted at the low-income market, and so we're looking at a different market. But more than 90% of our clients are new to insurance, so education remains a big deal. One key that we found is that the products drive the core business of our partners. They're not just another product that sort of sits on top of the mobile platform, but they actually are supported by management of our partners because they're designed to support key objectives of those partners. The coverage of 2 lives specifically has been key for driving growth. Ghanaians have told us that they want insurance when provided options. They want insurance for themselves as well as someone else. They want to benefit from the policy, as Anja referred to before, benefits during life. They want to benefit from the policy before they themselves would pass away. We also think in these products we've tapped into basic customer behavior issues, not just really demand for insurance. For example, the monthly SMS we send to customers on our Tigo products offers real visibility to the product and creates this interesting game where customers look forward to how much insurance they've earned. Not because they're expecting something bad to happen, but because they want to know how much they've earned. And so in this way, we're really trying to follow in the footsteps of consumer goods marketers, since that's how these partners think, and we have to match their mindsets. We initially thought the mobile channel could make almost every process cheaper as well as faster, but as Pranav mentioned earlier, education is one of those areas where we're not so sure. We think right now, purely because 9 out of 10 of our customers are brand new to insurance, that we have to spend 5 minutes with every customer during this initial period. But we do think in the long run, there are significant opportunities to use mobile technology to educate clients, either pictorially or through text. Some challenges we faced are listed there. Mobile does involve more complex partnerships. The infrastructure also isn't entirely dependable, which affects our technology platform. So if the MTN mobile network is down, we can't sell an MTN policy. And so a low-tech option is something that many days we felt might be more attractive. There are also some areas of product and process design that aren't completely perfect yet. We expect to learn and adapt as we grow. But we're very positive about the future growth potential of these products and really the mobile channel overall, not just for distribution, but education, administration, claims payment, etc. And we're diving into all those areas at the moment. We were greatly honored in June to receive recognition for our mobile insurance work from the Financial Times and IFC, which gave us first place in our category at the 2011 Sustainable Finance Awards based on these 2 products in Ghana. And so it's early, but we have some promising results, and we're looking forward to seeing other innovation in this space. I think I'll now send it to Brandon for a wrap-up.
Okay, I hope you can see my screen now. Thank you very much, Peter. So in wrapping up, what we've heard, and I guess what we probably know, is that what we call alternative distribution in the insurance industry, the rest of the world actually would call their primary place where they shop: supermarkets, cell phone outlet, the retailer, what have you. It's interesting, Anja and I once participated in a discussion about whether Safeway supermarket customers in South Africa were really micro enough for microinsurance. And I think as a group we finally resolved that while all segments might shop at Safeways, certainly the wealthier customers that are presently buying insurance are not buying their insurance at the supermarket, and so it is reaching into a new segment. It may not be all the way down the pyramid, but it's definitely including more people in insurance and making it a more viable business, and hopefully creating more customer value, or at least that's the work we have to do. As we heard from Anja, developing propositions, it's a lot of replication is required, a lot of trial and error. Starting with a product-centric view is going to wind up with a poor result, but where both partners or all partners are committed to value and value to the customer, that's going to have the greatest success. And obviously value to low-income families is ultimately why we do this work. From Pranav, we heard about the various innovations that are instrumental to reaching this segment. It's interesting, last fall the General Electric CEO Jeff Immelt wrote an article about reverse innovation, where he's talking about how not only is this important in low-income countries and to emerging consumers, but also to bringing those very frugal ways of doing business and bringing them into developed markets in order to compete there as well. And finally, Peter's outstanding example and presentation show the opportunity that's available here. I think there are a few areas in insurance that I can think of where one can double the size of an insurance market and win a prize from the Financial Times and the IFC for that effort, and it's really an outstanding result for him and for Microensure. So with that, and with our remaining minutes, I turn back to Jasmin, who will lead us to answering some of the questions you've been sending in.
Okay, thank you. Thank you, everyone. So now we come to the question and answer part. We have been gathering questions and comments throughout the webinar, and let's see how far we can go in terms of answering these questions. Maybe we can start with some of the questions we gathered during the registration. I read one question here. Are there examples of successful replication of innovative distribution channels from one country to another? So perhaps our maybe Anja, and I'm sure Pranav, Brandon, and Peter also has something to say with that. So maybe we can start with Anja.
Thanks, Jasmin. I think the answer is yes, although the models may not be exactly the same down to all the little details, you do find very much the same type of models, especially where you have multinational insurance companies playing in more than one country and replicating the same type of relationships with multinational partners in more than one country. But what I think is important to point out is that the replicability will be very much dependent on the country context and the nature of infrastructure in that country.
Thank you. Pranav?
Yeah, I certainly believe that such replication is possible. We've seen in the past hour or so that retailers have become prominent in South Africa and in India. Examples of Jet stores, the Haryali Kisan Bazaar outlets. In India also there's a growing concept of what you call mall assurance, where malls run by an organization called Pantaloons, which also has a general insurance company. It's a clothing outlet where people can actually buy simple personal accident products at these rural so-called malls in that sense. Plus, through the correspondent banking model in Brazil, where in-shops and in-shop displays within outlets have become popular, as was seen in the Bradesco example. Also, if you see, mobile phones have become extremely popular. There are examples on the Syngenta project in Kenya where weather index policies were sold and premiums were paid through the mobile phones. The Ghana example, you just heard Peter talking about it. India is also ready for confirmation and data transfer, both in health and in other products. But regulations do not permit currently the money transfer process. So that's the limitation. Otherwise, setting up a customer is possible across the world now.
Okay, thanks for that. Brandon, you have something to add?
Yeah, I'll just very quickly say that the key here is to achieve scale, and so making the replicable parts replicable is going to help to reduce costs to everyone. There was one of the major food producers had the quote that food is global but taste is local, and they were talking about making tomato soup, and they would make the basic powder everywhere and then add more spices in India and less spices in Philippines or what have you. And I think that's very, very much true here. Of course, we're going to have to change the flavoring in order for it to work in various markets, but the more that can be replicable, the more that we can make efficient, the lower we can bring the price and the more customers we can reach.
Okay, thank you for that. So our next question is from Abaymi Sule from Hygeia Community Health Plan. And the question is, how can retail channels and other non-financial channels distribute microinsurance products, especially when there are no enabling regulations? I think, Anja, you have something to say on that one?
Yes, I do, Jasmin. Thanks. I think the question here is, are there disabling regulations? So is there something in regulation that is prohibiting retail channels that are institutions from registering as intermediaries, whether it be agents or brokers, in some way? And if there is, I think there's always some way around it. In most cases, in the countries we have spoken to insurance regulators, they are very open to innovation, and they will most probably allow models like this to go ahead on a test and learn approach. The other thing that is also quite interesting around regulation and alternative distribution is that in some countries, like South Africa, strict market conduct regulation that speaks to which individuals are able to sell insurance and how that insurance should be sold, has in some cases actually triggered the development of alternative distribution channels, where companies find it simply too expensive to sell these products on a one-on-one basis, and they have to start taking different approaches.
Okay, thank you. Another question here from Michelle Marshalian from the London School of Economics. Could someone address methods for government involvement in microinsurance distribution? I think, Pranav, this is a question for you.
Well, I think the government and state has a huge role to play in creating not only an enabling environment, but also providing the tools for participation. And if you take the Indian example, you have clear-cut cases where the government has not only participated itself, but also worked with private insurers and private suppliers of financial services in expanding the reach of insurance and other financial products. The recent and the most obvious example being the Rashtriya Swasthya Bima Yojana, which is a state-run insurance scheme for below the poverty line population. Not only the government subsidizes the product, which facilitates the beneficiaries to experience insurance, paying a very small insurance premium from their side, but it also helps by giving to the insurer an infrastructure where they can actually go and insure. If you remember, our agent in the suitcase who actually goes out to the customers can actually sit at a local government school, can actually sit at a local panchayat office in a village so that people can come to him and get enrolled in the government process itself. This actually enables not only the insurer to be present close to the customer using the government infrastructure, but also builds trust in the customers because the government is actively involved in propagating the schemes, plus also one government nominee is present at the time of enrollment of the customer itself who certifies that the customer can be enrolled. Besides this, the government also supports the weather index based insurance in a huge way in India in notifying the crops that it can be done, in notifying the population it can be done with, as well as providing financial support to the customers in terms of subsidies to get enrolled into insurance itself. So we certainly believe that the government, and certainly one thing before I forget is that fairly enabling microinsurance regulations separate from the main insurance regulations have been rolled out in the country, which sets the stage for various other players besides the nationally recognized agents to become involved in the insurance distribution process. So it has widened the range of availability as well as reduced the entry barriers for a lot of these alternate channels to become microinsurance agents in the country. Thanks.
Okay, thank you. Okay, we have another question here from Adrian Castellon from Fundación Profin. How to make partner selection and implementation work best? How do you ensure that the channel feels committed to the product? Perhaps Brandon and maybe Peter afterwards, yeah.
Well, I'm going to repeat something that Peter said because I think he was spot on. Fitting it to the core proposition is absolutely key. Two examples from the Zurich book would be with Holcim, which is a cement and manufacturing company, a Swiss company that we work with in Indonesia. They're building low-income houses, very inexpensive houses, and along with that offering, we then put insurance for the home and eventually for the possessions. Or another one would be with Banco Sol in Bolivia, where Banco Sol wants to encourage savings, and so we have a deposit savings life insurance policy that triples the amount in the case of death, provides a survivor benefit, triple the amount that's in the savings account. So something that's actually going to align with and help enhance the core business of the distribution partner. Peter had it 100% right. That's very, very important.
Do you want to add anything to that, Peter?
Well, I would just say that we need to think a bit, innovatively about what sort of core business needs can be addressed by risk mitigation products. So there are easy ones like community reputation. That if a telco wants to increase or a retailer wants to increase its community reputation, that's pretty easy for us because of the social benefit of microinsurance. But customer retention, revenue, not just. I would shy away from looking at just products that can, add to the product suite. I really think we do have to identify the goals at the C level, and if we can help, the C-suite, basically be more successful in their jobs with organizations that get the client. To Anja's point, organizations that are really thinking about what the client wants and who the client is. I think that's the type of partner that you want to look at, and those can be a variety of organizations. So, yeah.
Okay, thank you. So maybe the last three questions, and I have one here. This is for you, Anja. So this is from Peter Reed. All Anja's examples assume the existence of an established distribution partner with wide outreach to the target market. But how many of those do you find in the typical microinsurance market? For example, the countries where people are considerably poorer than in South Africa, Brazil, and Colombia.
That's a very good question, Peter, if you're still here and listening. And it's something we've actually discussed before. I think the point here is that although the models I reviewed today may not be applicable in all low-income countries, I think the lessons around alternative distribution and what's required is. And I also think your question speaks to the one characteristic of alternative distribution, that you need some type of infrastructure, whether it's physical or virtual. And I think in most of the low-income countries, we do see a lot of that virtual infrastructure and brand power emerging, such as Peter's example of the 2 mobile network operators in Ghana, where you do have the virtual infrastructure as well as the brand and the partners. I think in most low-income countries you see virtual or e-wallets and the emergence of e-money and the involvement of mobile network operators in the space. But there are many other potential partners, such as church networks or even other more well-known brands in the market.
Okay, thank you. Maybe another question for you, Anja, from Stephen Burgess. How much can you buy for the small change, that's in quotation? The number of policies sold is significant, but does it provide value for money? Definitely innovative, but is it valuable?
That is also a very good question, Stephen, and it's also something we debated when we looked at this particular model. I think the first part of your question around, the level of cover, the premium cover ratio, I can't answer at this moment, but you can have a look on our website where we documented the full Colombian case study around CARICOR to get that exact number. But what we did found around value of this particular policy is that the claims rates are very, very low. And we think it's because people don't remember that they have bought this policy. I think it's very difficult to remember you bought an insurance policy and remember of its value to you when you do it as an afterthought with your small change. So we thought the product and the model is innovative in that it catches clients at a good time and matches their pockets. But I don't think it helps them to remember what they bought.
Okay, Pranav, do you want to add something to that?
Well, I was just trying to address the small change issue, and in our experience, personal accident policies have proven to be a good entry point for the so-called small change in one's pocket. They can be extremely valuable if, under unfortunate circumstances, there is a claim, and especially if you are there with a disability, then a PA come disability benefit can actually help you tide over your initial problems in a very cost-effective manner. So therefore, value of an insurance policy actually comes out when you actually claim it. And I'm sure there is value in even small ticket items, as we can see.
Okay, thank you. So maybe just in the interest of time, we can have one final question, and this one is for Peter from Stephen Burgess again. So the Tigo product seems to be embedded in the phone package because as they get more cover, the more they use the phone. Is that right? If so, presumably the phone rates are higher due to this free benefit. Can users choose to opt out of getting the insurance? Peter?
Yeah, actually everyone has to opt in. So it's not an automatic benefit that you get for being a Tigo subscriber. You have to opt into it. But the phone rates that you pay having opted in are not higher. The basic idea is that the product is structured to incentivize Tigo subscribers to use more airtime. And obviously, you can make it out, you can work it out for yourself whether or not that's working. But they don't pay higher rates. So customers actually have to opt in, not opt out. Now, there will be diminishing returns to that. And so that benefit will only last for a certain amount of time, and then we have to develop other products to continue to add value to customers and attract, But what's nice about it is that if we now ask customers to pay for insurance, we'll have hundreds of thousands that have had a positive experience with insurance, and then you're much more likely to get them to kind of pay for their own policies, whether life or accident or otherwise, because they've had an initial positive experience with a policy that literally is absolutely free to them.
Okay, thank you. So thank you to our panelists and thank you to everyone. I think that concludes our webinar. There is just a brief survey that will pop up in your screens when you exit the webinar. Please do take the time to fill it in so we can continue to improve the webinar series. There you go. See you all again in the next webinar.